Very good morning to one and all present here. Today, in this video, we will be learning about the different types of assessment in case of income tax authorities. Before we move on to the different types of assessment, let me tell you what do you mean by assessment. Whenever a particular individual starts earning any income through different sources, after we calculate the gross total income and after giving deductions under section 80C to 80U as per the Income Tax Act of 1961, we arrive at net total income. So if the net total income or the taxable income is exceeding a certain limit, say if your age is less than 60, if it exceeds 2,50,000, then you are liable to pay tax. So whenever an individual starts earning money and his earned money exceeds the taxable amount, he or she is liable to pay taxes to the Indian government. So that is called as assessment. The process of paying taxes beyond the basic exemption limit during a financial year is called as assessment. Now, whenever an individual files his return of income according to the Income Tax Act of 1961, he has to follow certain procedures and methods. Once you are a taxpayer, and you file your returns, the income tax department will process it. There are occasions where there are various parameters by which the Central Board of Direct Taxes will access or will check on the returns of a particular assessee based on the returns that you have generated. Now, when it comes to different types of assessment, we have various kinds of assessments, namely self-assessment, summary assessment, regular assessment, best judgment assessment, and income escaping assessments. So now we will check on what do you mean by self-assessment. Now under section 140A of the Income Tax Act of 1961 gives you a brief introduction about what do you mean by self-assessment. When an assessee or the person himself tries to determine the income tax the income tax to be payable by him or her for the income that he or she earns during a particular given year and tries to file the returns according to the knowledge that he or she has, then you call that assessment to be a self-assessment. Now, the total income of the assessee is then arrived at a particular point of time. And then, according to the total income, they calculate the deductions and they try to file the returns according to the knowledge that a particular individual has. So, this kind of assessment is known as self-assessment. Now we will move on to the second type of assessment called summary assessment under section 143 subsection 1 of the Income Tax Act 1961. It states that um, it is a kind of an assessment which is carried out without any human interruption, which means that the information will be submitted by the assessee in his return of income in crossed check against the information that the income tax department has access to. In this process, usually what happens is the reasonableness and correctness of the returns will be verified by the income tax department itself. The return gets generated online, and the adjustments of arithmetical errors or the claims or the allowances, etc., are automatically done by a particular system that has been generated by the income tax authorities. So such kind of assessment is called as summary assessment. Now we move on to the third type of assessment called regular assessment, which comes under section 143, subsection 3 of the Income Tax Act 1961. Under this kind of assessment, the income tax authorities uh, 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 below the rank of an income tax officer will conduct this kind of assessment. The main purpose of this kind of assessment is to ensure that the assessee has neither understated his income or overstated any expenses or losses or underpaid any tax. So the main reason of conducting a regular assessment is to check on whether a particular individual has filed his or her return according to the sources of the income that he or she has generated on a timely basis to the government properly or not. So they keep on checking whether the incomes have been accessed properly, whether the expenses have been deducted properly, there are no expenses that are overstated, and also they make sure that the tax are paid appropriately by the individual towards the government, and they also make sure that there is no amount paid as tax which is less. If there is any more tax that is paid by the individual, then they refund it to you. So the CBTT has a certain parameter based on which the taxpayer's case gets picked up, on a random basis, and they do this kind of assessment called regular assessment. Now we move on to the next type of assessment called best judgment assessment, which comes under section 144 of the Income Tax Act 1961. Now best judgment assessment does not usually happen in all the cases or for all the assessees. It is to be followed only in few scenarios or few cases, which is stated as here. The first is where the assessee fails to respond to a particular notice that is being sent by the income tax authorities. For example, they ask you certain explanations, you don't do that particular explanation, or they send you notice, and then also they find you not responding to that particular notice, then they will do a best judgment assessment. Second case where they come for best judgment assessment is when they compile with a special audit by the income tax authorities. And the third scenario is where the assessee fails to file the return within the due date or such extended time limit as allowed by CBDT. And the next scenario where best judgment assessment can be given is when the particular individual fails to comply with the terms as contained in the notice under the summary assessment. So whenever summary assessment is over, they ask you for a case, or they send you a notice and you don't respond to that, then they convert your summary assessment into best judgment assessment. So these are few scenarios where best judgment assessments will be conducted by the income tax authorities. Now, after providing an opportunity to hear from the assessee, then the assessing officer passes an order based on the relevant materials and evidence that is gathered from the assessee and submits it to the higher authorities. So this kind of process or assessing the return of income that you have filed is called as best judgment assessment. Now, the last type of assessment that we have is called income escaping assessment. Now, what is income escaping assessment? If a particular assessing officer or the tax officer feels that a particular individual is escaping from paying taxes or is paying less taxes, then he or she can start scrutinizing the income level of a particular individual. So the time limit for issuing a notice to reopen an assessment is 4 years from the end of the relevant assessment year. So there are some scenarios where these reassessment gets triggered as well. The first reason is the assessee's taxable income is there but has not yet been filed his return. Secondly, uh, the second scenario where income escaping assessment can be called upon is where the assessing officer has found to have either understated his income or claimed excess allowances or deductions which is not actually relevant to him or her. The third reason where income escaping assessment can be filed or called upon is when a particular individual assessee has failed to furnish the reports on any kind of international transactions or investments that he or she has done. So in these scenarios, only income escaping assessments can be called upon by an assessing officer or income tax officer. Okay, so hope in this video you have understood what do you mean by the types of assessment. Just to have a quick recap, we have different types of assessment and which are overall categorized into 5 divisions. The first one is self-assessment. The second one is summary assessment. The third one, regular assessment. Fourth one, best judgment assessment. And the last one is income escaping assessment. Thank you. Have a good day ahead.